Look, I'm going to be straight with you from the start. I'm a private commodities analyst. I've been stacking physical silver for 12 years, and I use this AI avatar because speed matters in this market. While everyone else waits for the evening news, I'm trying to give you the real-time picture. And right now, this morning, that picture is getting very interesting. Silver just touched $88.16. That's an all-time high. Gold is over $4,600. And if you've been watching the financial media today, they're telling you this is about electric vehicles. They're telling you it's solar panel demand. They're telling you it's a healthy industrial bull market. I'm here to tell you something different. And I need you to pay attention because what's actually driving this move could reshape your entire approach to portfolio protection over the next few weeks. This isn't about solar panels. This is about a potential Supreme Court decision that could create a $200 billion obligation for the U.S. Treasury. And if that sounds dramatic, good, because the math is dramatic. The implications are dramatic. And the fact that most people aren't connecting these dots yet is exactly why I'm recording this right now. Here's what I'm going to walk you through today. First, I'll explain the Supreme Court case that is sitting on the docket right now and why it matters to anyone holding dollars or dollar-denominated assets. Second, I'll break down what I'm calling the fiscal flight to quality mechanism, which is a fancy way of saying what happens when smart money realizes a government is about to face a cash crunch it wasn't planning for. Third, I'll show you the actual numbers from this morning's trading, including some very strange price gaps between Eastern and Western markets that should make you uncomfortable. Fourth, I'll address the skeptics, because I know some of you are thinking this is just more precious metals hype. And finally, I'll tell you exactly what I'm watching and what my personal plan is if certain triggers get hit. This is moving fast. So let's get into it. The case at the center of all of this involves Trump-era tariffs, specifically tariffs that were imposed between 2017 and 2020 on hundreds of billions of dollars worth of imported goods, primarily from China, but also from Europe and other trading partners. The legal challenge argues that these tariffs were implemented without proper congressional authorization, violating the constitutional separation of powers. Now, you might be thinking, okay, so what? Tariffs get challenged all the time. And you'd be right. But here's where it gets interesting. If the Supreme Court rules that these tariffs were unconstitutional, the legal remedy isn't just stopping future tariffs. The remedy is refunds. Refunds to every importer who paid those tariffs over a multi-year period. We're talking about companies that paid tens of millions, in some cases hundreds of millions, in what would retroactively become illegal taxes. And under U.S. law, when the government collects money illegally, it has to give it back, with interest. The estimates on the total liability vary, but the consensus among the legal analysts I've been following puts it somewhere between $180 billion and $220 billion. Let's call it $200 billion for our purposes here. That's the number I'm working with. Now, $200 billion is not a small number, even for the U.S. government. But here's the critical piece that most people miss. It's not about whether the Treasury has $200 billion in some abstract sense. It's about the timing and the mechanism of payment. When a court issues a judgment like this, there are deadlines. There are legal requirements for how quickly refunds must be processed. And unlike normal budget items that can be spread out over years or hidden in omnibus spending bills, court-ordered refunds create immediate liquidity demands. The Treasury doesn't just have $200 billion sitting in a checking account waiting for emergencies. That money has to come from somewhere. And there are only three places it can come from: cutting other spending, raising taxes, or issuing new debt. Cutting $200 billion in spending in a short time frame? Politically impossible. Raising $200 billion in new taxes? Same problem. Which leaves door number three. The Treasury has to go to the bond market and borrow $200 billion that it wasn't planning to borrow. And that's where the precious metals market starts paying attention. Let me slow down here and explain the mechanism, because this is the teaching moment. This is where you need to understand not just what's happening, but why it matters. When a government faces an unplanned massive debt obligation, what we call a fiscal shock, something interesting happens in the minds of investors. They start doing math. They start asking questions. The first question is, how is this going to be paid for? And as I just explained, the answer is almost always new debt issuance. The second question is, what does that do to the existing debt? And this is where it gets uncomfortable. If the Treasury suddenly needs to issue $200 billion in new bonds into a market that was not expecting it, one of two things happens. Either they find buyers at current interest rates, or they have to offer higher interest rates to attract buyers. In a normal environment, the Treasury can usually find buyers. But we're not in a normal environment. We're in an environment where the 10-year Treasury yield has been climbing. We're in an environment where foreign central banks have been reducing their holdings of U.S. debt. We're in an environment where the bond market is already showing signs of stress. So if the Treasury comes to market and says, hey, we need another $200 billion and we need it fast, what happens? Either yields spike to attract buyers, or the Federal Reserve steps in and buys the bonds itself, which is just a fancy way of saying they print the money. Both of those outcomes are poison for the dollar. Higher yields mean the government's interest expense explodes, which creates a death spiral where you're borrowing more just to pay the interest on what you already borrowed. And if the Fed prints the money, you're directly devaluing the currency. This is what I mean by fiscal flight to quality. When investors see this dynamic setting up, they don't wait for the disaster to happen. They move their capital out of the currency and into assets that can't be printed. Historically, that's been gold, but increasingly, it's also silver, and here's why silver moves like a rocket when this happens. Market cap. The entire above-ground silver market, all the physical silver that exists in investable form, is tiny compared to the bond market. It's tiny compared to the gold market. When the exit door out of the dollar gets crowded, silver's door's smaller, less supply, more violent price moves. Think of it like this. Imagine a bank realizes they've been overcharging customers for 5 years. Suddenly, a judge orders them to refund every penny by the end of the month. The bank doesn't have the cash on hand. They have to borrow it at whatever interest rate they can get, just to keep the doors open. That whatever interest rate moment is the fiscal shock. And the customers who hear about this before the announcement, the ones who start withdrawing their deposits early, those are the people buying silver right now. That's the mechanism. Now let me show you what it looks like in practice. This morning, a few hours ago, I was looking at my screens and the numbers were striking. Silver spot price, the ask side, was $88.16. That's up 4.45% just today. Gold was at $4,611. Platinum was at $23.57. Palladium at $18.70. Those are the numbers you can see on any financial website. But here's what you can't see unless you're watching specific markets. The Shanghai Gold Exchange, which is the primary physical trading venue in China, was showing silver prices equivalent to $98 per ounce when you convert yuan to dollars. Let me say that again. New York is pricing silver at $88. Shanghai is pricing it at $98. That's a $10 premium. Now, in normal markets, you get small premiums between regions. Shipping costs, local demand, currency conversion fees, $1 or $2, maybe $3 in extreme cases. But $10 on an $88 asset? That's an 11% premium. That doesn't happen in a functioning market. What that tells me is that physical silver is being pulled out of Western vaults and shipped east as fast as it can be moved. When you see a price gap like that, what you're seeing is arbitrage. Traders are buying in New York at 88, selling in Shanghai at 98, and pocketing the difference minus shipping costs. But here's the problem with that arbitrage. It only works as long as there's physical metal available to buy in New York. And when you're moving hundreds of millions of dollars worth of metal based on a $10 gap, those vaults empty fast. I'm not saying we're at that point yet, but I'm saying the gap is a stress indicator. It's telling you that the physical market and the paper market are starting to disconnect. And when that disconnect persists for more than a day or two, you start getting into dangerous territory where the Western price becomes irrelevant because there's no metal available to buy at that price. The other number I'm watching is the dollar index. The DXY has been relatively flat today. It's not showing the kind of collapse you might expect if the dollar was genuinely in crisis. And that's important because it tells you that the mainstream market hasn't priced this in yet. The bond market is still operating as if everything is normal. The currency traders are still operating as if everything is normal. But the silver market isn't. The silver market is vertical. And that divergence, that gap between what silver's doing and what the dollar index is doing, that's your early warning signal. That's the canary in the coal mine telling you that a small group of very smart, very well-connected traders are positioning for something the mainstream hasn't figured out yet. Now, let me address the demand story because I know this is what you're hearing everywhere else. The narrative is that silver is rising because of industrial demand. Electric vehicles need silver for their electrical systems. Solar panels need silver for their photovoltaic cells. There's a green energy transition happening, and silver is a critical component of that transition. All of that is true. Industrial demand for silver has been growing, but let me give you some context on the numbers. Annual industrial demand for silver is around 600 million ounces. That's roughly half of total silver demand. The other half is investment demand and jewelry. If this move was purely about industrial demand, you'd expect to see it develop gradually over months or years as factories ramp up production and supply chains adjust. What you wouldn't expect to see is a 4.45% vertical move in a single morning. That's not how industrial demand works. Industrial buyers plan their purchases. They hedge. They lock in prices with long-term contracts. They don't panic buy at all-time highs. What does create 4% moves in a single morning? Financial flows, investment demand, people moving capital out of one asset class and into another because they're worried about the value of the asset class they're leaving. So when I see silver up 4.5% in a few hours, And I know there's a $200 billion fiscal shock potentially coming. And I see a $10 premium in Shanghai. I don't think solar panels. I think currency hedge. Let me take you through the math on what a $200 billion treasury obligation actually means in practice. Because I think this is where a lot of people lose the thread. 200 billion sounds like a big number, but it's abstract. Let me make it concrete. The current U.S. national debt is around $36 trillion. The annual interest expense on that debt at current yields is around $1 trillion. That's $1 trillion per year just in interest payments, not paying down any principal. Now, if the Treasury has to issue $200 billion in new debt, that adds to the $36 trillion, but more importantly, it adds to the annual interest expense. At a 5% yield, which is roughly where the 10-year Treasury is trading, $200 billion in new debt means $10 billion per year in additional interest expense. That might not sound catastrophic on its own, but here's the compounding effect. The bond market isn't stupid. When the market sees the Treasury coming with a surprise $200 billion issuance, they're going to demand a higher yield to compensate for the increased risk. Maybe they want 5.2% instead of 5%. Maybe they want 5.5%. And here's where it gets nasty. The U.S. debt doesn't just sit at one interest rate. As old bonds mature, they get rolled over into new bonds at current rates. So when rates go up, the interest expense on the entire debt stock gradually increases over time. If this Supreme Court decision pushes yields up by even 0.5%, you're looking at an additional $180 billion per year in interest expense across the entire debt stock as it rolls over. That's $180 billion per year every year forever until rates come back down. And how do rates come back down? Either the economy collapses and the Fed has to cut rates to prevent a depression, or inflation gets so bad that the Fed has to hike rates even higher to fight it. Neither of those scenarios is good for the dollar. This is what I mean by a death spiral. The fiscal shock creates higher borrowing costs. Higher borrowing costs create more debt. More debt creates even higher borrowing costs. And somewhere in that spiral, investors lose confidence in the currency's ability to hold value. That's when they buy silver. Now let's stress test the Shanghai scenario because I think this is actually the more immediate risk. If the $10 premium between New York and Shanghai stays open for another 48 hours, you're going to see massive physical flows out of Western vaults. The London vaults, which are the primary storage and trading hub for precious metals in the West, hold somewhere around 1 billion ounces of silver. That sounds like a lot, but when you're moving metal at the scale we're talking about, it's not infinite. If the arbitrage opportunity stays open, you could easily see 100 million ounces or more move in a week. And if the market starts to suspect that London is running low on deliverable silver, that's when you get a force majeure event. That's when the exchange says, sorry, we can't deliver physical metal at the paper price. Settlement will be in cash or delayed delivery. And once that happens, once the paper market decouples from the physical market, the paper price becomes meaningless. The only price that matters is the physical price. And that price is set by whoever has metal and whoever is desperate enough to pay for it. I'm not predicting this happens. I'm saying it is a risk scenario that becomes more likely the longer the Shanghai premium stays elevated. And right now, this morning, it's at $10. That's elevated. Let me hit the checkpoint here because I want to make sure we're all on the same page before I move forward. Here's what we know so far. There's a Supreme Court case that could result in a $200 billion refund obligation for the Treasury. That obligation would have to be funded through new debt issuance, which would either spike yields or require the Fed to print money. Either outcome is negative for the dollar. Smart money that sees this coming starts moving into hard assets like silver. Silver is up 4.5% this morning, which is more consistent with financial flows than industrial demand. And there's a $10 premium between New York and Shanghai, which suggests physical metal is being pulled out of Western vaults. That's the setup. Now, let me deal with the skeptics, because I know there are a lot of people who are going to hear this and think I'm being alarmist. The first skeptical argument I hear all the time is this. The $200 billion refund will take years to process through bureaucratic red tape. The Treasury isn't going broke today. This is a slow-moving problem, not a crisis. And look, I get it. Government moves slowly. Legal processes move slowly. It's entirely possible that this gets tied up in appeals or implementation delays for months or even years. But here's the thing about markets. Markets are forward-looking. They don't wait for the disaster to happen. They price in the disaster the moment it becomes likely. And if the Supreme Court rules that these tariffs were unconstitutional, even if the refund process takes 2 years, the market prices that in immediately. Liquidity doesn't drain slowly. Liquidity drains in seconds. The moment the big institutional players decide that U.S. Treasury bonds are riskier than they thought, they start reducing their positions. And when trillion-dollar institutions start reducing bond positions, yields move fast. So the idea that we have years to prepare because the refund process is slow, that's missing how markets work. The market reaction happens now. The fiscal crisis happens later. And by the time the fiscal crisis is obvious to everyone, it's too late to position for it. The second skeptical argument I hear, especially from the precious metals community, is that high yields kill silver. The logic is that when interest rates are high, people prefer to hold bonds because they're getting a safe, guaranteed return. Why would you hold silver, which pays no yield, when you can get 5% risk-free in treasuries? And in normal times, that logic makes sense. Higher yields are competitive with precious metals, but we're not in normal times. We're potentially entering a fiscal crisis. And in a fiscal crisis, high yields don't represent a competitive return. They represent default risk. Think about it. Why do yields go up? Because buyers demand more compensation for risk. When the Treasury has to offer 5%, it's not because they're feeling generous. It's because the market is saying, or we need 5% to make it worth the risk of holding your debt. And when yields spike to 6%, 7%, 8%, that's not an opportunity. That's a warning. That's the market saying, we think there's a real chance you can't pay this back, so we need to be compensated for that risk. When the bond market is on fire, you don't stay in the burning building just because the yield is high. You get out. And historically, where do you go when you get out of the bond market during a fiscal crisis? Hard assets. I want you to look at the 10-year yield right now. It's moving up alongside silver. It's not moving inversely to silver the way it does in normal markets. Both are going up. And that's your signal that the old rules are breaking down. That's your signal that we're not in a high yields versus precious metals dynamic. We're in a fiscal crisis dynamic. The third skeptical argument, and this one is more subtle, is that the dollar index isn't collapsing. So how can this be a dollar crisis? And I addressed this earlier, but it's worth repeating because it's a good question. The dollar index measures the dollar against a basket of other currencies: euro, yen, pound, Canadian dollar, Swedish krona, Swiss franc. And right now, those currencies are all dealing with their own problems. Europe has its own debt issues. Japan has been fighting deflation for decades. The UK just went through a bond market crisis a couple of years ago. So when the dollar index stays flat, it doesn't mean the dollar is strong. It means the dollar is less weak than the other weak currencies. It's a relative measure, not an absolute measure. Silver, on the other hand, is an absolute measure. Silver doesn't have a central bank that can print more of it. Silver doesn't have a government that can devalue it through fiscal policy. Silver is silver. So when silver is going vertical and the dollar index is flat, what that tells you is that the problem is systemic. It's not that the dollar is uniquely weak. It's that all fiat currencies are weak relative to hard assets. And the smart money is figuring that out before the mainstream does. All right, let's talk about what happens next. Because this is where the rubber meets the road. This is where you have to start thinking about your own positioning and what scenarios you're preparing for. The first thing I'm watching is the institutional reaction. Specifically, I'm watching the CME, the Chicago Mercantile Exchange, which is where silver futures are traded. When there's a big vertical move like we saw this morning, the exchange has a tool they use to cool things down. It's called a margin hike. Margin is the amount of cash you have to put up to hold a futures position. If you're trading silver futures, you might only have to put up 10 or 15% of the contract value as margin, and you borrow the rest. It's leverage. When the exchange sees volatility they don't like, they can raise the margin requirement. Instead of 15%, now you need 20%, or 25%, or 50%. And when they do that, it forces traders who are using leverage to either put up more cash or close their positions. If you can't put up the extra cash, you have to sell. And when a lot of traders have to sell at the same time, the price drops. This is a classic tool for cooling off a market that's moving too fast. And I expect the CME to use it. I would not be surprised at all if by market close today, or tomorrow morning at the latest, we see a 25 to 50% margin hike on silver futures. Now, is that a bad thing? Not necessarily. It depends on your positioning. If you're trading paper silver with heavy leverage, a margin hike can wipe you out. But if you're holding physical silver, margin hikes don't affect you at all. In fact, margin hikes that force leverage traders to sell can create buying opportunities in the physical market. So I'm not panicking about the margin hike. I'm expecting it, and I'm watching to see how the market reacts. The second thing I'm watching is media coverage. And this is going to sound conspiratorial, but I need you to understand how financial media works during crises. There's a phenomenon where major financial events get downplayed or ignored in the first 24 to 48 hours, while the connected players position themselves. I'm not saying there's a smoke-filled room where people decide what gets covered. I'm saying that financial media relies on official sources. They wait for statements from the Treasury, from the Fed, from major banks. And those institutions don't comment on market moves in real time. They wait, they assess, they craft their messaging. So what you often see is a gap, a lag, where the market is doing something significant, but the media narrative hasn't caught up yet. And during that gap, retail investors are operating on incomplete information while institutional players are acting on complete information. If this Supreme Court decision is as significant as I think it could be, I expect the media to pivot to it in the next day or two. But right now, this morning, the narrative is still industrial demand. And that gap, that difference between what the market is pricing in and what the media is talking about, that's your edge as an informed investor. The other thing I'm watching, and this is more specific, is technical difficulties on price tickers. Now, this sounds paranoid, but I've been in this market long enough to have seen it happen. During the 2011 silver spike, when silver was approaching $50, there were multiple instances of trading halts, website outages, and price feed delays on major platforms. Were those deliberate? I don't know. Maybe they were just technical glitches caused by high volume. But the effect was the same. Retail investors couldn't see prices, couldn't execute trades, while institutional players with direct market access could. So I'm watching for that. If you start seeing your brokerage app go down, or price feeds and stop updating, or orders take unusually long to execute, that's a signal that the market is under stress. Now let me give you my personal dashboard. These are the indicators I'm watching over the next 48 hours to decide what I do next. Indicator number 1, the Shanghai Premium. Right now it's at $10. If it crosses $12, that tells me the physical shortage is getting critical. At $12, you're looking at a disconnect that can't be explained by normal market friction. That's a signal that the Western price is becoming irrelevant and the real price is being set in the East. If I see that premium hit 12, I'm going to be very cautious about assuming I can buy physical metal at the paper price. I might start looking at paying premiums to lock in physical inventory before it becomes unavailable at any reasonable price. Indicator number 2, the US 10-year yield. Right now it's around 5%. If it crosses 5.5%, that's a signal that the bond market is breaking. That's a signal that buyers are demanding significantly more compensation for the risk of holding US debt. And if the yield goes to 5.5, while the Supreme Court decision is still pending, that tells me the market is pricing in a worst-case scenario. That's when I start thinking about moving more capital into physical assets, because a bond market in crisis is a currency in crisis. Indicator number 3, government response. Specifically, if the Supreme Court rules against the tariffs, I'm watching to see if the government announces any kind of stay or delay on implementation. If they do, that relieves the immediate pressure. It gives the Treasury time to plan. It gives the bond market time to adjust. If that happens, if there's a stay, I expect silver to pull back significantly, maybe back to 75, maybe even lower, because the immediate panic subsides. And at that point, I'd be looking for re-entry points at better prices. But if the court rules and there's no stay, if it's immediate implementation, that's when things get interesting. That's when the fiscal shock becomes real. All right, let me walk you through my personal battle plan. And I want to be very clear, this is not advice. This is not me telling you what to do. This is me telling you what I'm doing, based on my own risk tolerance, my own capital situation, and my own read of the market. Your situation is different. Your plan should be different. Right now, this morning, I'm not chasing this vertical move with new long positions in paper silver. The move has already happened. We're at all-time highs. The risk reward of buying here at $88 after a 4.5% move, that doesn't appeal to me. If I didn't already own physical silver, would I buy here? Probably not. I'd wait for a pullback. But I do own physical silver. I've been stacking for 12 years, so I'm sitting on gains. And my concern right now is not how do I get more exposure, but how do I protect the exposure I have? Here's my trigger point. If silver hits $92 today, I am personally looking to hedge my physical stack by buying put options on SLV, the silver ETF. Not because I think silver is going to crash, but because I think there's a real risk of a margin hike-induced sell-off that could take us back down $10 or $15 very quickly. And if that happens, I want to be hedged. I want to make money on the downside to offset the paper losses on my physical holdings. Then, if we do get that sell-off, I can close the puts for a profit and use that profit to buy more physical at lower prices. That's how I'm thinking about the near-term volatility. Not am I bullish or bearish, but how do I protect myself from whipsaw moves while maintaining my long-term position? My second trigger is the 10-year yield. If the yield crosses 5.5%, I'm moving a portion of my liquid cash into physical metal regardless of the premium. And I know that sounds counterintuitive. Why would I buy at a premium when I just said I'm not chasing the move? Because if the bond market is signaling a liquidity crisis, the premium doesn't matter. What matters is having the metal. What matters is not being stuck holding cash or bonds when everyone realizes they want to hold something else. In a real fiscal crisis, you're not trying to optimize your entry price. You're trying to get through the door before it closes. And a 5.5% 10-year yield, in the context of a $200 billion fiscal shock, that's the door starting to close. My third trigger is the government response. If the Supreme Court rules and the government announces a stay, I'm sitting on my hands. I'm not selling my physical, but I'm not adding either. I'm waiting to see how the situation develops over weeks instead of days. But if there's no stay, if it's immediate implementation, then I'm looking at this as a potential black swan event. And in a black swan, you don't worry about perfect positioning, you worry about survival. You worry about having assets that can't be devalued by policy decisions. One more thing I'm watching, and this is more subtle, the rhetoric from the Federal Reserve. If the Fed starts talking about maintaining orderly markets or ensuring liquidity, that's code for we're getting ready to intervene. And Fed intervention, in the context of a fiscal crisis, means printing, it means quantitative easing, it means expanding the balance sheet. And all of that is bullish for hard assets over the medium term, even if it creates short-term volatility. So I'm listening for the language. I'm listening for the signals that the Fed is preparing to backstop the Treasury. Because once that happens, once the market knows the Fed is willing to print to solve the problem, that's when you get the real currency devaluation. That's when silver doesn't stop at 90 or 100. That's when you start talking about 150, 200. I'm not saying we're there yet. I'm saying I'm watching for the signals. Let me also address the safety piece, because I know some of you are thinking about leverage, about using margin, about trying to maximize returns on this move. And I want to be very direct. Be careful. The volatility we're seeing right now, the 4% moves in a morning, that's the kind of environment where leverage kills people. You can be right about the direction and still get wiped out by a margin call during a temporary pullback. If you're going to trade this, use capital you can afford to lose. Use position sizes that let you sleep at night. And have a plan for what you do if the price moves against you. For me personally, the only leverage I'm comfortable with in this environment is options. And even then, I'm using them defensively as hedges, not offensively as directional bets. Physical metal, the stuff I can hold in my hand or store in a vault I control, that's my core position. Everything else is tactical positioning around that core. All right, let's bring this home. Let me recap what we've covered and give you my forecast for the next few days. We've got a potential Supreme Court decision that could create a $200 billion obligation for the U.S. Treasury. That's not some distant future problem. That's a decision that could come down any day now. And if it does, the fiscal shock is immediate. Silver is at $88, an all-time high. And the move this morning was consistent with financial flows, not industrial demand. The $10 premium in Shanghai tells us that physical metal is being pulled out of Western vaults at an alarming rate. The bond market isn't pricing in the crisis yet. The mainstream media isn't talking about the connection yet. But the silver market is. And that gap, that difference between what silver is doing and what everything else is doing, that's your signal. Over the next 48 hours, we're going to see whether this is a flash in the pan move or the beginning of something bigger. We're going to see if the Shanghai premium persists or closes. We're going to see if the CME hikes margins to cool things down. We're going to see if the Supreme Court makes its decision or delays. And through all of that, the question you need to ask yourself is, am I positioned for a scenario where the dollar loses credibility? Not loses value against other currencies, but loses credibility as a stable store of value. Because that's what a fiscal shock does. It doesn't mean the dollar goes to zero overnight. It means confidence erodes. It means people start asking questions they weren't asking before. It means the assumptions that held for decades start to crack. And when those assumptions crack, when people start to wonder if the US government can actually manage its debt burden without printing or defaulting, that's when hard assets become not just an investment, but insurance. Here's my rallying cry, and I mean this sincerely. The mainstream narrative wants you to believe this is a demand story. They want you to think silver is going up because of solar panels and electric vehicles and a healthy industrial transition. And maybe there's some truth to that. Maybe industrial demand is part of the picture. But it's not the whole picture. It's not even the main picture. The main picture is that the financial system is under stress. The main picture is that governments have borrowed more than they can realistically pay back without debasing their currencies. The main picture is that we're one court decision, one fiscal shock, one liquidity crisis away from a repricing of everything. And the people who see that, the people who understand that, they're not waiting for confirmation from CNBC. They're not waiting for the Treasury to admit there's a problem. They're acting now. Don't be exit liquidity for the banks. Don't be the person who figures this out after everyone else is already positioned. Pay attention to what the market is doing, not what the media is saying it's doing. This is moving fast. The next 48 hours could be decisive. And whether you're buying, selling, or holding, make sure you understand why you're doing it. Make sure you've thought through the scenarios. Make sure you have a plan. I've given you mine. I've shown you my triggers. I've explained the mechanism. Now you need to build your own map. And if you want to understand the historical context for this, if you want to see what currency collapses actually look like when they happen, I've got a deep dive on the Weimar silver move from the 1920s. It's the blueprint for what happens when a government tries to print its way out of a fiscal crisis. The link is in the description. Stay sharp, watch the indicators, and don't let anyone tell you this is just about solar panels.